Hi, everybody. I'm starting just a teeny bit early because this is our first class, and I want to make sure that everyone can see my desktop, see the book says Elementary Discussions, What is Elliott Wave Theory? So if you'll notice on your control panel for GoToWebinar, there's a section at the bottom that says chat and questions. So if you can just type in the question or the chat section, preferably the question section, because it'll keep, and if you can see my computer screen and if you can hear me. So I guess that would be yes, yes, or yes, no, or no, no. I guess if it's no, no, then you don't know I'm even asking the question. But just let me know if you can see both the screen. Okay, good. So it looks like everybody can see. Magelan, is there anything you need to cover real quick before we get started?
Hi everyone. Everybody will get the recording automatically meeting. If you don't, just email me and I'll send the recording to you later on today or tomorrow.
Yeah, the system base should send you the recording based on your email that you have already entered. So as long as you have a good email address entered, then it should automatically go to you. It takes an hour or two for the recordings to be processed and uploaded, whatever they do with those. So it's not right away. So just give it some time. And this will give you a chance to review everything and make sure you're comfortable, and then you can formulate any questions from that when you get started. So I actually promised in the promotional material that I would take some just general questions before we get started. A lot of this I'm sure will be covered, but if there's anything that you really have a strong need to know, then maybe I could just get to answering that right now. So if you use the question section that a lot of you just said yes to, you can ask your question there, or you can email the question to NEoWave@neowave.com, and try to keep your questions to one per person per week, more than this class, and I'll transfer those to a special folder in my email program, and from there I'll show you how I do this. So from there we have this section in my online email where we can actually put the questions here, and that's where I'll, at the end of each week, I guess it's Saturday for a lot of you on here, but it's Friday night in California. So I'll put the questions here, and then I'll try to go through those if they're important, relevant, if they haven't already been answered, that sort of thing. Okay, so let's go ahead and get started. I see your hello, so it's working on this end. So I'm going to get started. I guess we'll just answer questions at the end if you have any questions about what we've talked about today. First of all, the primary point of this group seminar, a lot of people, when they get my book, they start reading, and maybe chapter 1 and chapter 2 are fairly easy and straightforward. But when it gets to chapter 3 and maybe chapter 6, 7, and some of the latter chapters like 11 and 12, they get very overwhelmed or confused, or they don't understand, or they make assumptions. So this review of my book, done years after I wrote it, basically it is 30 years since I wrote it, allows you a new perspective. Someone who now has 30 additional years of market experience, 30 more years of applying wave theory in real time, seeing patterns that didn't exist when I wrote my book, and understanding a lot better how to make the process easier, simplify it, so I can reduce at least dramatically reduce quite a bit of the complexity of chapter 3, and help you design a process of analysis that is simpler than some of the stuff that's mentioned in my book. So it should actually help make the application of wave theory easier for you by taking this class and making the book more valuable. And for those of you who have a copy of the book, you can go through and actually put in notes, either post-it notes or with a pencil or a pen, and possibly change information that's in the book, things that I've realized that since I wrote it aren't quite accurate or have changed. So you can to the book as we go through it. There's not going to be a lot of those kinds of things, but mostly it's in the application process and the way you begin your analysis, things like that. So let's go and get started with the basic stuff. For those of you who are really, really new to wave theory is basically the graphic representation of mass psychology. So when you're looking at a market, say the US stock market or any major country stock market, you're looking at everyone's hopes and fears and beliefs and expectations and information. It could be inside information. All this stuff combines together into a singular result, which is the movement of price of a particular market or an index or commodity. So wave theory is the collection of everyone's reaction, everyone's beliefs into a single currently viable price to transact business for a particular thing. And it's through this accumulation of information that you can read the movements of price action to get an idea of the psychology that's currently developing in a market. And the psychology will give you very strong clues on where a market's actually positioned. If you're in a very pessimistic environment, that would be typically near a major market bottom. If you're in an extremely optimistic environment, that'll be near a major market top. So and there'll be various levels of optimism and pessimism, fear and greed, paranoia, anything you can individually feel psychologically can be manifested by a large group of people. And when the majority of the people are all feeling the same thing at the same time is generally when a psychological trend comes to an end and you start a new sequence. And wave theory applied in what I call the NEoWave fashion, which is a sophisticated version of Elliott Wave, allows you to best predict the conclusion of trends and the start of major new trends that you can then predict very often to some degree the duration, the size, the magnitude, the complexity of those new trends. It is a non-periodical phenomenon, so a lot of people probably think of wave theory as being like cycle analysis, and you're looking for repetitions of cycles, but it's not that kind of phenomenon at all. It's a building phenomenon where it's always building on the past, and it, progress grows and grows with a society and with humanity. And then there'll be periods of time occasionally where things happen and people over speculate or they overinvest or they overindulge. And so trends come to an end and you start going in the counter direction for a while. It could be, analogous to working really hard during the week and then taking a break for the weekend. Markets go through the same kind of phenomenon, but on a mass scale. So it is non-periodical, and it does have a direct connection to fractal theory, if you're familiar with that, and chaos theory. And a big part of the theory is based on the Fibonacci number sequence. So we'll be discussing some of that as we go along here. What makes it unique is that it's unlike most technical tools that are going to be best used in a specific kind of environment. Wave theory allows you to work with all environments. Even if you're not able to predict the behavior all the time, you have at least an idea of what kind of environment you're in and the kinds of things to expect. Like, for example, moving averages work best when a market's been in a, has already bottomed or topped and it's in the sort of middle trending phase from a high to a low or a low to a high. Overbought, oversold indicators would work typically better near a market top or a bottom. Fundamental analysis would work best at the early stages of a major environment of pessimism before the wealthy investors come in and collect a lot of positions while the majority of the public is getting out and selling their positions. During bad economic times, the public is getting out because they're selling their stock to use the money to survive and to pay their bills. And those positions have to be sold to someone. So those positions are being collected by those with excess wealth and money set aside that they don't necessarily need to survive. but they can use to buy up positions when the majority of the public doesn't want them. So you have fundamental types of analysis, which works best at market extremes. You have moving averages, which work best during the trendy parts of a market after the high or the low has been comfortably made. And you can have top and bottom picking technology or techniques that can work well during consolidation markets where you're near high and you go short and you're near bottom, you go long, and it keeps doing that back and forth. So there's various types of tools that work in different environments, but wave theory sort of encompasses all these things. Now, it doesn't mean you can always predict what's going to happen. We'll be talking much later about when you can and when you can't, but it is unique because it does apply in all environments and gives you a perspective on the viability of trading, the safety of trading, the potential for trading, the dangers, and so forth. Let's go on to the next page. The reason you might want to learn wave theory, now I have to say that learning wave theory is not easy. Like, it's not like using a moving average where if it's positive, the trend's up, and if the moving average is negative, the trend is down. It's not that kind of simplistic approach. It's a much more complicated perspective on reality, and you have to learn a lot of things and learn to remove your own personal emotions and deal with markets more objectively, which is what my book is all about. So why learn the theory? Well, it can be extremely helpful for those who might have a business such as a real estate business or some kind of company that's dealing with public consumption of a very important product. It could be oil or commodities like gold, something where there is a lot of participation, and you as a company, should I build this apartment complex or should I build this mall, or is it the right time in the economic development of the country or the region to be investing that kind of money? Will there be long-term potential? Or maybe you're building a real estate project at the end, it's much riskier bet and you would stay away from that. So it can have real application in anticipating large economic projects by large corporations. So that's where it could be extremely useful. If you're an individual trader, it can be very helpful when you're trying to get in at the lowest cost possible, the lowest risk possible with the highest potential. So the smaller your trading account is, the more important it becomes to get in at extremes so that you don't have a lot of risk in the other direction. So it can be helpful for people who are starting off in their trading and wanting to get in with starting off with small accounts. So those are some of the areas that learning the theory can be useful. It is applicable to many different areas, as I mentioned, real estate, the production of goods and services. So, over my lifetime, it has provided at real crucial points, especially the lows in 1982, 83, 84, when it was obviously we're starting a bull market, the peak before the crash of 87, the lows in 1988, 89, when it was clear the market was over, at least to me, even though most Elliott Wave analysts were super bearish for a really long time. The peak in 2000, when the market was near the peak in 2000, wave theory was telling me that we were getting ready to begin a multi-decade correction. And so I knew for the next 20 to 30 years, we were going to be mostly dealing with very complicated corrective action, and that the markets would not be as easy to predict or as tradable as they were, from 1982 to 2000. So having wave theory gives you a much better perspective on what is possible. So I knew after the peak in 2000 that we would be going sideways in a very large range, and that the market near the high in 2000 was at its most susceptible that it had been since the high in 1987. And I was actually on national television more than once in that time frame saying that we were getting the biggest market decline of my lifetime, and that the Dow would drop at least 50%, the S&P at least 60, and the NASDAQ at least 70. And all those things came to pass within about, I think it was a year and a half to 2 years. So that, that was a really nice thing to know. It actually helped me save my mother from losing a lot of money and my family from losing a lot of money. So it can have great uses for long-term perspectives, along with shorter-term trading at crucial market extremes. The other cool thing is, as you get better at it, a lot of the other things that most people use, such as moving averages, overbought indicators, sentiment, all these kinds of things become a lot less necessary, because wave theory can give you a complete perspective when it's applied with logic and reasoning, instead of having what I call crutches, technical crutches, to try to help you with a wave count. You normally should not have to use anything external to price action and wave structure to predict what's going to happen next. And the more you depend on those things, the more likely the potential faults and frailties of a particular indicator will force you or manifest themselves onto the count and force you to believe things that aren't actually going to be correct, especially at extremes. A lot of technical indicators don't work really well right at the extremes, because they're designed to deal with the vast majority of the time when a market's moving from a bottom to a top or vice versa. Extremes only happen for very short periods of time. The rest of the time, the market's drifting toward a target, or trending toward a target. So most technical indicators are designed around markets that are going somewhere, and less where markets that are major extremes. With wave theory, because you only get high clarity at the conclusion of a pattern, so at the end of an ABC flat, or at the end of a 5-wave move, or at the end of a triangle, between the beginning and the end, there can be some flexibility, sometimes a lot of flexibility, and not necessarily high clarity on what's going on and what to do. But it's at the very end that it's the most useful, and it's sort of a paradox, because when wave structure, using the rules described in my book, when wave structure is the most clear is when you're going to know very confidently what a market's going to do next, but nobody's going to believe you, because at those crucial junctures, the majority of the psychology will be believing exactly the opposite of what the wave pattern is telling you is getting ready to happen next. So, at the high in 1987, when I was talking about a major market meltdown that could occur within 3 months, I didn't expect most of it to happen in one day, but I did indicate we would drop about 25% or more within about 3 months. I didn't know why. It was a little hard for me to personally believe, but that's what the wave count was telling me. Same thing at the high in 2000. There was broad-based, massive euphoria and excitement. And I remember I was on a TV show in Los Angeles right into February, March of 2000. And before we went on live camera, the anchor was sitting down just chatting with me, and he handed me this book that said Dow 100,000. And I said to him right away, I said, oh, well, that's it, the top's end, because the Dow at the time was not even at 10,000. And as a general rule, anytime you start hearing people predicting a market's going to double, triple, quadruple its current level, or drop in half, or in 1/4 or 1/10 of where it currently is, that's always an extreme, especially if you're hearing it from more than one source, and especially if you hear it on TV or in newspapers or magazines. So when I saw that there was an actual book released, Dow 100,000, that was more than 10 times higher than where the market was currently trading. So I knew that was it, the bull market was over. And that turned out to be the very month that the high was made, and the market went sideways and down for the next 2 or 3 years. So let me move on to the next page. As far as why the controversy exists, I mean, this is not probably evident to most of you now, but when I first wrote my book, it was quite a thing, especially because a year or two before I wrote my book, I had written an article for the Foundation for the Study of Cycles, and that was in summer, August, September of 1988. And that's when I was predicting that the crash of 87 low was done, that the bull market was going to resume, and that we would never break the low of 1987 for the rest of my life. And people thought I was out of my mind at the time. They were ridiculing me nationally in papers and publications, thought I was stupid, didn't know what I was talking about. And so that created quite a bit of a controversy when my book came out and sort of, explained how I did my analysis. There was a lot of people saying, oh, I've changed the theory, I've made it too complicated, all these rules that I have, I'm just making the stuff up and so forth. So it just enhanced the controversial nature of it. And if y'all haven't seen that article and you have my book, it's in the very back of the book. It's the last 4, 5, 6 pages of the book. That was written again in 1988. And that forecast has now been there for 30 years and is still basically correct. And we still have about, what is it, about 70,000 Dow points to go before we reach the minimum expected target, which is approximately 45 years from now. So I still think that forecast is correct. I still think it's all going to pan out as I mentioned. And that was all done using the concepts in my book at the time and even up to today. I've virtually made no significant changes to that long-term count. There's been some minor adjustments here and there, but overall the general forecast is still the same. Now, with the help of this discussion that we're going to be having on my book, I think the time to master it will be sped up quite a bit. You still will have to study pretty hard and memorize a lot, but when you do the process of analysis, as I'm going to describe in the next 12 weeks, it should make it a lot easier to get better at this much faster. So I think most of you will appreciate that, because the biggest impediment to most people is the time it takes to get good at it. And I'm going to show you ways to speed up that process. Let's see, a lot of this stuff is sort of self-evident, so I don't think I need to go through all of that. Okay, so why don't we open up the session to asking some questions. We're going a little bit faster than normal here because chapter 1 is, very, very simple chapter. There's not that much to talk about. So does anyone have any questions at this point so far that I can go into a little bit of detail? I think I did get somebody's question by email the other day. I'm going to double check on that. While I'm looking, y'all can ask your questions in the questions section. Give me a minute here. I'm just going through my emails real quick. Okay. Okay, no, I don't see anything there. Okay, I'm not getting any questions so far. So let me just continue on here. The wave theory can be applied. Oh, here comes one. This comes in from Ray. So you mentioned that Elliott Wave does not rely on indicators, that is a strict logical reasoning. That's correct. So you don't need to look at other forms of analysis to justify, even though I see people doing this kind of stuff all the time, it is basically unnecessary. The only time you would want to use external indicators for wave theory is if you have multiple scenarios and you're not sure what to do or which scenario is correct. I'm going to be explaining to y'all later on, much later on as we get into the later chapters, how to actually deal with environments that you have 3 or 4 or 5 counts. If you've gotten any services from other Elliott Wave analysts, this won't apply to me because I really don't do it in my service, but if you've gotten analysis from other people, it's fairly common that they might have 3 or 4 or 5 alternate counts. And they might even list all of them. And the funny part is, of course, if you have a bullish count and a bearish count, well, then you can never be wrong. You just pick whichever one turns out to be correct, and then it makes you look good. So I want to make it very clear, if you're getting any kind of service in which the analyst is providing constantly a bullish and a bearish scenario, then they don't know what they're doing. Because if wave theory is to have any credibility, if you want to consider it some kind of scientific process of analysis, which I do, and it's sort of a scientific and logical process of analysis, then you should be able to arrive at one directional opinion. It shouldn't be, it's either bullish or it's bearish. It should be clear. Generally speaking, I'll have bullish counts or more bullish counts or bearish counts or more bearish counts, but I don't have bullish and bearish counts, especially not really bullish and really bearish. That's ridiculous. If you're ever in that situation, you always want to pick, I'm sort of giving a little bit of information way ahead of time, but if you're ever left with multiple scenarios, you want to pick the count closest to the middle. So if you're, say, one count that shows you're in wave 1, one count shows you're in wave 2, one shows you're in wave 3, one shows you're in wave 4, and one shows you're in wave 5. If you come up with that, that means your counting is really bad. But let's just say you had 5 scenarios, then the count that puts you in wave 3 is going to be the one that's the far most likely to be correct, because it's the count that puts you in the middle. Realize as you move toward the middle of formations, the number of scenarios will increase. It's similar to the concept of, at least in America, I live in America, so it's easy to talk about it from my perspective. Let's say you live in Los Angeles and you're wanting to drive to New York City. Well, when you initially leave Los Angeles, there's only probably 1 or 2 or 3 major highways that you would leave on. There may even be only one that makes the most sense. That's going, toward New York, not going north, not going south, not going east, but going maybe directionally toward New York. So there might be 1 or 2 that really make sense. As you get further and further away, there's going to be branches in the road, and you can go a little bit north, a little bit south, a little bit east. You're obviously not going to want to go west, but you have 3 different potential directions you can go, with 2 being the most reasonable, east and north. But every time you get to a major new state or major new intersection of major highways, you could possibly take a different route and eventually still get to New York. So the closer you get to the middle of the country, the harder it would be for someone who knows you're driving from New York, from Los Angeles to New York. It'd be harder and harder for them to predict where exactly you are based on knowing how fast you're driving and where you're heading, as long as you drive nonstop. The closer you get to New York, then the easier it gets to predict which road you're coming in on and where you're going to end up. So wave theory works the same way. As you're near the center, there's going to be lots of possibilities potentially, and they should all generally be bullish or bearish, but there'll be varying degrees of bullishness. There'll be ones that take a little bit longer, ones that take a little bit shorter, ones that are going to finish sooner, ones that are going to finish later. So in that environment, when you have multiple counts to choose from, you're always going to want to pick the count closest to the middle. And eventually, all these extraneous surrounding sort of deceptive scenarios will start to disappear as you get closer to the end. And when you're really at the end of a pattern, you only have 1 good count, or maybe 2 that both indicate the exact same conclusion and scenario going forward. So it should never concern you when you have multiple counts. That just means you have a long way to go and the trend isn't over, and you should be more patient during those periods. Okay, so let me go back to the questions. Oop, I think I just went backwards a little bit here. Okay, let me go back to the questions here. So the first question, Ray, does that answer your question about using indicators and why they may not be necessary if you understand how to use multiple scenarios to help identify where you are? Does that make things a little bit easier for you? I could unlock your mic if you want me to. Let's see, I'm gonna find you on the list here. Okay, so Ray, if you want to unlock your mic, it should be open right now.
Hi,
Does that
yes.
answer?
Yeah, no, I just had it does, but I just had one follow-up question. In my reading,
Okay.
some folks have said that MACD, for example, is something that's helpful in arriving at wave counts. Do you agree with that or disagree with that?
I just find it's rarely ever necessary to use. The only external indicator I sometimes use is sentiment, because wave theory is based strongly on psychological pattern development, and it helps you to understand where you might be in the patterns. I have really never used external indicators, moving averages, or any of that kind of stuff to produce good wave structure, because if you're applying the rules and you start from the largest time frame and you work your way down, usually it's pretty obvious where you are, and it's just not necessary. So I personally don't use it, and I never even attempted to use MACD to verify wave counts.
Okay, thank you.
Okay, and you had another question. It looks like, could you expand?
It was just what I just said
Okay.
about
Okay.
MACD. Yep.
Okay, so go ahead and put your mic on mute, and if you, hopefully you know how to do that. It may not
Oh,
be obvious,
yes,
but
yes, I can do it. Yeah, here.
okay. And Punchai, it looks like you have a question. Let's see. Are you going to cover about new NEoWave patterns? Yes, we'll be talking some about, neutral triangles, diametric patterns, symmetrical patterns. Now, for those of you who are not aware, I'm going to go ahead and pull up a page on my website, which does have information regarding new pattern development. So if you go to neowave.com and you click on education, and of course, later on you can review this tape and do the exact same thing I'm doing right now. Scroll down a little bit and you go to question of the week. I haven't been answering questions for a long time because I pretty much answered just about every question that could be answered. But you go to question of the week, and then you can type in almost anything you want to know about, especially new kinds of patterns. So you can type in the word diametric, which is a new phenomenon that began a few years after I wrote my book. It's a 7-legged kind of pattern, but you can see here there's 1, 2, 3, 4, 5, 6, 7, 8, 9, like 15 or 20 different questions regarding diametrics. And you can just type that in and read all these sections about diametric patterns. If you want to read about symmetricals, then you can do the same thing. A symmetrical is a 9-legged formation, which we again will go into some detail on that much later. These are more complicated patterns, so I don't go over these early on, but you can see all this discussions there. You can also look into what I call neutral triangles. Those are the third kind of triangle that's not discussed by R. and Elliott. There was expanding triangles and there was contracting triangles that he talked about, and then there's neutral triangles where the middle leg is the longest leg. So it makes sense because you have 5-wave moves where wave 1 can be the longest, wave 3 can be the longest, or wave 5 can be the longest, or you can have triangles where wave A is the longest, wave C is the longest, or wave E is the longest. So the one that was missing from Elliott's original materials was the one where wave C is the longest. So that's what qualifies as a neutral triangle, and it talks about that if you type in neutral triangle. You can also look up reverse alternation. That's something that's not discussed too much, I don't think, in my book, but it does happen in the real world. So this will be where you may have a 5-wave move where wave 1 is the biggest, but wave 2 is smaller than wave 4. So you get reverse alternation. In the third wave, finishes way above the top of wave 1, and wave 4 is a very deep correction of wave 3, and the 5th wave may fail or barely make a new high. So it talks about reverse alternation and triangles and 5-wave moves and stuff at this point on the website. So again, you just go to neowave.com, click on the education section, scroll down a little bit, go to question of the week, and almost anything that you want to ask about that's you may have heard about or I've mentioned in my service that's not in my book, you can just type in the term here, do a search for it, and find out about that particular phenomenon. Okay, so Lowell is asking me Excel files incorrect. I could provide those of you who want to get Excel files. These are cache data files. Normally those are only provided for people who are taking my wave theory class because it's more high level stuff. But we do have cache data cache data files that will automatically plot the daily, weekly, monthly, and high lows for the S&P, cash, the gold market, cash gold market, cash T-notes, which is based on the 10-year cash yield, and the cash euro market. So if you want those, you can write to Magelan later and ask about that. We don't support that because it's a thing really designed just for me to use to create the charts that I use in my service. But if you want to, be able to get good cash charts to use and practice on your own, then you can do that. And on those charts, at least initially, you'll see the counts that I currently have in my wave service. Now over time, of course, they'll change as I change my count, but you can follow along if you want to. Okay, so let me unlock Lowell, I guess is how you pronounce your name. Let me go ahead and scroll to you. I'm going to unlock your mic real quick if you want to say anything further on that question that you had. Oh, are you there? Because he's not there. Okay. Okay. Well, if there's any other thing you wanted to ask, just let me know. Let me go ahead and delete that question. Okay. And then Panchai says, in this class, we're going to cover new. Yeah. Okay. We already covered that question. And Panchai, let me go and unlock your mic regarding the Dow 100,000 forecast. You know, when I first made that forecast, the Dow was at 1900. It's now at almost 30,000. So, but people thought I was stupid. I was ridiculed by everyone about that. So Panchai, did you have a question about that forecast that I made 30 years ago?
No.
Okay. So I answered your question?
Yes.
Okay. Okay,
Thank
so
you.
go ahead and put your mic on mute. Hey, Terrence, I didn't realize you were going to be in this class. So let me see. Your question is that based partly on the fiat currency? No, it's just based on wave structure. So when I look at the Dow structure going back to the, I can't remember how, it goes back, I think, to the 1800s in the US, and then connecting that data with European stock market data, which is a little clunky, but it goes back to, I think, 1765, if I remember correct. I can't remember the exact date, but that was taking super long-term market data. And I actually have that in the back of my book. We can actually take a look at that real quick now that I think about it. Let me see if I can zoom. Okay, we're on page location 329. Let me see if I can find that page here. Okay, yeah, so here is the long-term forecast in the back of my book, and I'm going through all the problems with the historical count and why it's wrong. Let's see, this might, unfortunately, there's a problem with this iCloud reader, and sometimes it gets caught up and it doesn't want to you know, function right, so I have to actually close it and reopen it. So let me go ahead and do that real quick. Okay. Okay, so this is the article that's in the back of the book. So if any of you have my book, you can go to the back and read about it. I talk about the actual data. This goes back to 17, I can't remember the exact date, 1760, 1780, somewhere in there, 1789. Okay, so this is what it looked like. So this is all the data I had to work with. And when I looked at this chart, I realized quite a few things that apparently all the previous Elliott Wave analysts who had, you know, come years before did not really recognize. Most of them were calling this wave 1, this wave 2, and this wave 3, and this wave 4. And then ever since then, for 30 years, 40 years, every Elliott Wave analyst, just about except for me, has been saying this is wave 5 and it's going to top and it's the end of the world. And 1987 was the end of the world, and 2000 was the end of the world, and 2007 was the end of the world, and you know, now it's going to end at any time. We're going to go into depression. It's been going on for years and years. But if you look at the center structure, what most people are calling wave 3, you can see it's the deadest, choppiest structure in the entire history of this chart. It starts up with a little quick spike, and then it goes sideways for decades, and then one little spike into 1929. This is not the way a third wave should behave. Shouldn't have the spike at the beginning and the end, and then all the middle is just dead action. So that was very clear to me long time ago that this count couldn't possibly be correct. So this whole discussion in the book is discussing what must be going on and how we come to those conclusions, and that it was obvious to me based on this behavior there must have been historical action that was not recorded. Obviously the stock market or human progress had begun before they started a US stock market or before they started a European stock market. So, you know, economies were growing, people were progressing, things were happening way before there was an official stock exchange. So I realized that I had to project backwards in time based on all the evidence of where the market probably began. It was a very elaborate, complicated process. but I predicted that it had started around, at least on a log scale, around 0.3 something, and that the peak in 1929 was around 20, and then we went through the correction. And this was all part of wave 2, because this couldn't be an impulsive pattern, so it had to be corrective. And it was all part of an upward drifting corrective pattern. And if y'all have a copy of my book, I don't know if I have it in this article. My book's in the other room, but there's a diagram. I'm not sure if it's in this article. Let me see. No, it's not. In the back of, somewhere in my book, I think it's chapter 8, I talk about what's called a double 3 running correction. And that's where you get an ABC, an X wave rally, and another ABC, and then the market takes off really fast. So the interesting part of all the price action since 1949 in the US is that beginning here, the stock market has been advancing faster and faster than any prior point in history, further and faster. So this indicates that we're coming out of the strongest correction in stock market history that began with the boom of the 50s and 60s in the US, and then continued through the, this upward drift continues through the 87 peak sideways and went through the extreme powerful move up into the year 2000. All this is part of a very strong long-term third wave advance that began around 1949. And that's why the market just keeps going up and up faster and faster, seems to defy our reality, defies logic. It just doesn't seem to make sense. But it's because, as I mentioned in my article, that the whole world is moving toward a industrial, capitalistic, and now technological environment. So the whole world's becoming industrialized, the whole world's becoming technologically advanced, and it's allowing the standards of living of everyone in the world to get better and better. So we're not closer and closer to the end of a bull market and the end of civilization. We're actually getting long-term closer and closer to one of the greatest economic periods that any of us will ever experience. And I think that'll begin somewhere around the year 2025 to about year 2065. I think that'll be a new golden age for humanity, similar to the Renaissance in the 1600s. It'll be similar to that, but economically benefiting the entire world instead of just certain countries. So Terrence, I tried to unlock your mic earlier, but there was a lot of background noise. I'm not sure if you heard me or if you can even unlock your mic, but I'm going to assume that answers your question, that it's not based on fiat currencies or inflation. It's just based on human progress and wave patterns. Okay, I have a few other questions there. See, Manish, let's see, which Manish is this? I've taught a few Manishes in the past. Let's see. I don't think I've spoken with you before, Manish. Says, is your experience under what market stages Elliott theory is less useful and difficult to apply under which markets? I'm going to go and unlock your mic, Manish, if you don't mind. It's the, you should be able, no, it says you're on, so I'm not sure if I'm going to be able to hear you, but you can give it a try.
Yeah, hi. So,
okay.
Yeah, so my name is Manish. I wanted to check with you, based on your experience, under which situations have you observed that the theory doesn't give the best, just like the best understanding of the market situation we are in, and it is somewhat difficult to apply, and then likewise there will be some situations where it is best to apply and then it gives the best results. So,
yes, it will be useful more toward the beginning and end of major trends and less useful near the center of major patterns. Like the high in 2000 until just recently was constituting about a 20-year corrective environment in the US stock market. Even though the market's going higher, it's still in this very large corrective environment. And we'll be probably looking at charts about that, much later. But when you're in complex multi-decade corrective environments, it's going to be much more difficult to predict what's going to happen next and where you are. And that's when other types of technical analysis or trading probably would work better. Wave theory is not great at dealing with corrective environments and helping you trade sideways action. And we've been mostly in a corrective environment for nearly 20 years since the high in 2000. So it hasn't been useful for trading for a long time. I expect around the year 2025 that wave theory will have a renaissance, and it'll be unbelievably useful for 3 or 4 decades after that. But because it's not been very useful for about 20 years, its reputation has been harmed by those who continue to make all these crazy into the world kind of forecasts that on constantly over and over and over, because they're trying to predict in an environment where it's not really that useful to make very specific predictions. So right now, the perspective I'm getting from wave theory is that we're in this large corrective environment. The trend on a monthly basis is generally sideways up, but we're getting closer to an important top. We might be a few months to maybe a year away, but we're getting closer. The risk of being long is getting greater and greater, but you don't want to go short yet because the structure is just not finished to justify going short. So I hope that answers your question, that wave theory is useful more in impulsive, trendy environments and less useful during complex, long-term corrective environments. Does that answer your question?
Yeah, yep, it does. Thank you. Thanks a lot.
Okay, so go ahead and put your, maybe I have to mute you, I'm not sure. I'm just gonna go ahead and mute you. Okay, so Roy had another question. He said, I have 2 hardcover versions of your book, both say version 2 with 223, but it's slightly thicker. Actually, the 223 pages, I think if you're talking about the last few pages of that article written in 1988, that was part of, I think, a Cycles magazine issue. So I don't think you're reading the page number of the book. That's the page of the article that was copied when that article was reprinted. My book is by chapter, so it'll be a chapter and then the page in the chapter. So it'll be like 5-10 or 12-2. So my pages aren't just numerically numbered. So that page is something that's part of an article in a magazine, and that was the page number in the magazine. So does that answer your question, Roy? I'm gonna see if I can find your name. I have to scroll through a lot of names here. Okay, so if you wanna mute your mic, does that answer your question, Roy?
Yes, it does. Thank you. Thanks, Glenn.
Okay, and there were 2 versions of my book. There was a simpler version and there was a more complicated version. Simpler version came out in 1988 called Elliott Waves in Motion, and that had a very simplistic chapter 3, and I think chapter 6 was smaller and a few other chapters were smaller, but chapter 3 was dramatically smaller. And I sometimes wish I had never gone to the trouble to expand on chapter 3, because it turned out to be the point where most people stopped reading my book. And I'm going to show you as we go through this how you can avoid all that complexity of chapter 3 and deal with things in an easier way. I wish I had had the chance to rewrite that chapter and redo it, but I've moved on to other things and it's just not that crucial to me. But in this class, we'll be talking about how to do that. And you said, does it work? This is Alnor is asking, does it work on non-liquid markets such as penny stocks? No. Remember, wave theory has to do with mass psychology. So you want to make sure you're dealing with the reactions of thousands or millions of people, not just a few. So I do not recommend it for any kind of small company, small stock, something that's not traded, on a national basis. I think that's the whole question. As far as cryptos, yes, it should work with large cryptocurrencies like Bitcoin. I think Bitcoin and gold probably are, and Bitcoin may even be better, probably the purest psychological markets that exist, because a lot of people don't realize, but the amount of gold in the world is the same now as it was 10,000 years ago. Either it's under the ground and it's mined or it's not, but the amount is always the same because gold is an indestructible element. You can't do anything to it. You can't burn it. You can't, throw acid on it. You can't change it. That's one reason why it's so valuable. So it just gets moved around. So the value of gold is strictly based on what man thinks it's worth and believes it's worth. And of course, it does have industrial use, but it is an indestructible element. So the amount stays the same. And coincidentally, Bitcoin was designed to be a digital gold, and the amount of Bitcoins in the world is 21 million, and that's it. It can't go any more, can't go any less. Now, a lot of Bitcoin has been lost, but that's still all part of the human phenomenon, and it's all completely human created, and its value is human decided. So I think there's a good chance Bitcoin might be the best market in the world for doing wave analysis. And so over time it could be I'm thinking of transitioning my currency market, my euro currency, into Bitcoin instead, because I don't feel the euro currency is quite as popular, and that Bitcoin will become a much more significant phenomenon going, in the next 10, 20 years. I personally think Bitcoin is going to eventually take over the entire world's financial system, and so it'll be decentralized, just the way that Apple destroyed the music companies, like Tower Records in America, and those kind of stores were destroyed by iTunes. And then of course they had the online video service, and then you had things like Netflix. All that destroyed the video stores, and the bookstores were of course destroyed by Amazon. I think that Bitcoin is going to destroy the entire international banking system, and so eventually it'll be a very free world financially. There won't be those who are controlling and making a little bit of money off of everybody's transactions. It'll be minus the middlemen, and it'll become a much fairer world. And I think Bitcoin will play a major part in that. Anyway, so let's see. I'm going to go to Alnor, and I'm going to unlock your mic. And if you had any additional questions about that, it says you're self-muted, so you'd have to unlock your mic if you want to ask an additional question. But I think I answered it. Okay, moving on to Chris. If psychology is the main determinant since writing your book, what is going on with psychology and new patterns of parametric? Okay, that's a really good question, actually. Nobody's ever asked that before. Well, if you start off with impulsive patterns, that's an environment, depending on the kind of impulsion you're dealing with. You have first wave extensions, you have third wave extension, you have fifth wave extensions. So if you deal with it for each one of those, the first wave extension pattern would be an environment where people are bullish, but everyone jumps in very early. And because they jump in early, there's not a lot of potential left after that. So most of the trend happens right away, and most people are jumping in toward the end of wave one. They have to suffer through wave two. They might get out before wave three begins, but there's not a lot of long-term potential. So there's a lot of anticipation. And so that would, a first wave extension would be strong anticipation of a big bull market, but it doesn't really pan out that much. A fifth wave extension would be continuous doubt, where people just don't believe it's going to happen. They think every rally is the end of the trend. Wave one's the end, wave three's the end, and then wave five, toward the end, finally convinces the majority that the trend is up. So it's a capitulation thing toward the end. But a fifth wave extension pattern is psychologically created by constant doubt and suspicion that the trend's actually going to last. Third wave extension, I'm not sure how to psychologically explain a third wave extension, but it would be where the majority jumps in toward the middle of the trend and toward the end of the middle of the trend, and then the fifth wave barely makes a new high. So they're not making much more money on the trend, and they typically get caught into the fourth wave and have to sort of suffer through it and get disappointed by that phase. So that would be the ways that psychology can play into five wave moves. With triangles, like contracting triangles, you have a massive panic that begins with wave A of the triangle, and that panic makes everyone think, if it's going down, makes everyone think it's the very beginning of a much larger decline that never actually happens. In an expanding triangle, there's a lot of belief that the market's going to trend, and every breakout, it's going to be the start of the new trend. And so people are buying the new highs and getting stopped when it makes new lows, and then selling the new lows, and then buying the new highs and selling the new lows. So they get chopped to death, and finally when the end of the move occurs, they're probably tired of trying, and they just give up, and they don't attempt to trade anymore, or maybe they've lost too much money in the process. So an expanding triangle would be an environment where you think it's going to break out and move, but it just never does. So the opposite of contracting triangle, where you're convinced the trend is one direction and you keep trying to get in, but it just never happens. So, as far as describing the psychological environment of a diametric or a symmetric I just know that they're different than flats and zigzags and triangles. And we'll be talking very specifically what makes them different, but it mostly boils around time. When you're dealing with let's say that you have 10 days to form a pattern. So your impulsive pattern was 10 days, or let's say the impulsive pattern was 10 days. Now, based on the rules in my book, a correction that's of the same degree needs to take at least 10 days. So if it's going to be a 3-legged 10-day correction, well, then you could have wave A take 1 day, wave B take 5 or 6 days, and wave C take 3 or 4 days, and that would get you your 10 days. If your correction is going to be a triangle, then you have to fit 5 waves into those 10 days. So each of them is going to be somewhere around 1 or 2 days, maybe 3 days, but they're going to be more similar. You're not going to have a situation where wave A could be 1 and wave B could be 5 or 6. So they start to get a little more similar. As you go from a triangle, which is 5 legs, to a diametric, which is 7, you're going to have to force those 7 legs to fit into those 10 days. So that means each leg is going to be pretty much about 1 day, or 1.5 days, 0.5 days, but it's going to all be around 1 day plus or minus a little bit. And then you go to a symmetrical, which is 9 legs. All the legs are going to pretty much have to be 1 day. Otherwise, you can't form the pattern. Now, the reason they have to be similar is because patterns that are of the same degree have to be similar of time, price, and complexity to be considered the same degree, and that's discussed in Chapter 4. We'll get to that, 3 or 4 weeks from now. But the patterns are more, the way they're designed, the way they develop is based on how much time do you have and how many waves does the market want to form within that allocated amount of time. And that's what differentiates or decides between flats, triangles, diametrics, and symmetricals. So let me unlock your mic real quick, Chris. Okay, so Chris, do you have any questions or comments about that?
Yeah, that was a pretty detailed explanation, which is good. Just what role do you think that maybe fund managers and technology is playing in stretching those patterns out since the psychology way back in the 80s? I mean, obviously everyone was on the run and the crash came and the fear was there and it's sort of still stuck in their minds. And then institutions come along and, don't allow cap a move and, run stops, stuff like that.
Yeah, it definitely changed things. There's no doubt about that. But remember, wave theory is a constantly building, non-repetitive phenomenon. So as man grows, as technology grows, standards of living change, all that gets integrated into the human experience and the human behavior. But it's the people that make the decisions, and they're making those decisions based on the current standard of living, the risks, the rewards, all these different things, how much money they have, is the economy good, is the economy bad? So all of it sort of gets amalgamated into one decision process as a whole, which is the single price movement of the stock or the economy or the index or whatever. So all that is automatically incorporated into wave theory, and realize that you're building pattern on top of pattern on top of pattern. So at no point in history is the psychology exactly the same as it ever was in the past.
Right. And you said before, as long as it's directional, meaning that you can clearly see that it's on an upward direction from the year 2000, but yet it's still corrective.
Yeah, that we'll have to get into that another day, but it's similar to what we're seeing here, where this is clearly a corrective rally, because the only movement we see is right at the beginning, right at the end, and all the rest of it is just sideways dead action. This is not impulsive behavior. So we're experiencing similar phenomenon on monthly and 6 monthly and 2.5 year time frames, where the action from the low in 2009 is all just a bunch of corrective action. It's not impulsive action. So
well, thank you.
Can you put your mic on mute?
Yes.
So this brings up an important thing. When people say, well, how can we be correctively moving upward? What are we correcting? Well, remember, corrections is just a word. It could be, any word. It could be mumbo jumbo. It's just something that describes a type of behavior. So impulsive action describes behavior where a vast majority of people are participating in a trend. They believe in the trend and they're trying to make money from it. Corrective action happens when a lot of people aren't sure about what's going on. They're not highly committed. They're sort of waiting around. They're, jumping in and out a lot. So it's a type of psychology that creates corrective action that's separate from the psychology that creates impulsive action. So when you're going up correctively, you're not correcting anything. You're just behaving in a corrective fashion, which means there's not a lot of commitment, there's not a lot of certainty, there's a lot of uncertainty, and so forth. Okay, Patham has a question. What's the effect for not plotting charts like you? Oh, that's a really good question, and we will get into that a little bit later when we get into chapter 2 regarding plotting. But you have to plot your charts properly to understand the information that's described in my book. One of the reasons I've been able to actually discover the things that I have is because of insisting on a very specific kind of plotting of wave structure. And that's using cache data, number one, which is very important, and then plotting the highs and lows in the order they occurred. And we can go through all this discussion later in chapter 2. So it is very important that you plot your charts properly. If you're using bar charts, you're not going to be able to figure out and discover a lot of the things that I've figured out when I wrote my book. So we will be going into a great deal of detail on that. So I don't use candlestick charts. I don't use bar charts whenever I'm doing wave analysis. I do use those for trading and using what I call Neely river theory. Some of you may or may not be familiar with that, but Neely river theory has to do with a trading technology as opposed to a forecasting technology. Elliott Wave and NEoWave. NEoWave stands for Neely extensions of wave theory. So it's my additions and innovations added to the original theory that creates NEoWave. But NEoWave is a forecasting technology. Just because you know what a market's going to do doesn't mean you're necessarily going to be able to trade it and make money off of it. So realize that forecasting and trading are two different things. A wave theory can give you a very nice sort of construct and environment in which to make decisions, but it may not be able to give you specific trading advice or give you the best way of approaching something, especially when you're in the middle of correction. So that's when other kinds of technology can be very useful. And we can talk about that another day. Okay, so I think we're gonna have to wrap this up because this is where I normally would cut it off. I have to take a little break for my next class on actual trading begins, which is the Neely river theory classes. So if you had some questions that weren't answered, then you can put those in an email and you can email them to me. Please try to keep it just to one question per week and email this to NEoWave at neowave.com. I'll store those into the folder for this class, and then next week we can go through those questions and then go into the next chapter. I think I'm gonna have to close this real quick. I just want to make sure that we actually finished this chapter. I think we did, but hold on a second, where is that? What's going on? It's not drawing. I'm not sure if y'all can hear me. Looks like my computer just froze up a little bit. Oh, there it goes.
We can hear you.
Okay. Go from Marcus first. Okay, so I'm just going to make sure we went through all the rest of the pages here. Yeah, this is all just sort of chit-chat stuff. The extensions I made to wave theory will be discussed in quite a bit of detail as we go through this. So realize there was the orthodox theory, and then when I started studying wave theory, I realized there was a lot of missing elements and ingredients to make the process more scientific, more objective. And so that's what I call the Neely extensions of wave theory, and that's where NEoWave came from. I don't think I need to talk about how I discovered the concepts, that's not important. I did spend an amazing amount of time doing all this. I'm sure now it's in the 60, 70, 80,000 hour time frame. I'm not sure what it is now, but because I wrote the book 30 years ago. So as far as application, I'm going to be talking about how you start the wave analysis process, and you always want to begin it from the largest time frame and work your way down. I know in my book I say it the other way around, but unfortunately that was 30 years ago. I didn't know as much then when I wrote the book, and it actually works much better when you start from the largest time frame and go down, not from the smallest time frame and work your way up. This is a great advantage because it dramatically simplifies the process of application. So you're going to love doing it this way because you'll figure out where you are much faster than doing it the other way. Okay, so let's leave this with chapter 2. This is where we'll start next time. I'm going to go ahead and close this, and we can call it a day now. So there are a few questions still lingering. So if you didn't get your question answered, just copy it and email, send it to me, and we can go through it next time. So I appreciate it. Hope y'all enjoyed it, and we will get into a lot more detail starting with the next class on how to plot charts, create charts, and begin the analysis process. Okay, I'll talk to y'all next week.